this sell-off in gold and silver is really a godsend. These lower prices give you a better entry point. I don't think they're going to fall that much more. And even if they do, they're not going to stay down. A lot of these foreign central banks are going to take advantage of this pullback in the price of gold. Below 4,500, they'll be big buyers. And we should sell gold and silver because inflation is higher. That makes no sense. Now, their logic is inflation is higher, so the Fed is going to have to fight harder to get rid of it. Traders are going to figure out that this is not, bearish for gold because, the Fed's going to have to hold off on rate cuts, as if holding off on rate cuts is even going to matter. It doesn't matter to me why people got fooled or why they were forced to sell. I'm not selling any of my gold. I'm not selling my silver. I'm not selling my mining stocks. At a minimum, hold tight. If you're comfortable with the position that you have, there's nothing that you need to do. The trend is our friend, and the fundamentals got stronger this week, not weaker. This sell-off in gold and silver is really a godsend for people who still need to buy. Look, I wasn't going to tell any of my clients to sell their gold and silver, so it doesn't matter that the price is not 5,500 anymore. It's 4,500. If you're not going to sell your gold, it doesn't matter. What matters is what's it worth when you do sell it, or what's it worth when you end up using it as money to buy stuff, because the people that have stuff that you want won't take anything but real money. They won't want dollars because they've lost too much value, and they're going to lose too much more value in the future. So since we were still accumulating, the fact that the price is down just means that if we need to get more, if you didn't think you had enough gold, if you didn't think you had enough silver, now you've got a pullback. Now you've got an opportunity to add to it. And if you were sitting on the fence and you never bought any gold or silver, well, hey, these lower prices give you a better entry point. They let you buy more gold and silver for fewer dollars, even more so in the mining stocks. We've had a much bigger correction there because the environment for these stocks, even if the price of gold and silver were to fall more, these stocks are still ridiculously cheap.
The gold and silver pullback isn't a threat. It's a strategic window. As Peter Schiff points out here, prices falling to $4,500 aren't catastrophic if you never sell. The real question is purchasing power against tangible assets. Investors who panic often miss that opportunity to accumulate more at lower prices, especially in mining stocks where valuations are still depressed. This dip exposes how paper dollars are losing real value faster than headlines admit. Next, Peter Schiff discusses why these pullbacks create one of the strongest buying opportunities for serious long-term investors.
But I don't think they're going to fall that much more. And even if they do, they're not going to stay down. I think gold and silver are going to recover maybe even faster than they went down. See, normally you think markets go down faster than they go up. But in the metals market, when this turns, it could be the opposite because it's going to be a mad rush to get out of dollars and into something real, into gold and silver. When the traders who have been selling gold on the hotter than expected inflation news recognize and realize that high inflation is good for gold. Think about it. Inflation is higher than everybody thought. And their natural reaction is, we have more inflation than we thought, so we should sell our inflation hedges. We should sell gold and silver because inflation is higher. That makes no sense. Now, their logic is inflation is higher, so the Fed is going to have to fight harder to get rid of it. What they need to understand is that inflation is so bad that there's no point in even trying to fight it because the Fed can't. The Fed is powerless to fight inflation. That's why it pretended that it already won the fight, because it had to surrender in a way that it didn't acknowledge that truth to the market.
Traders are misreading inflation signals and mispricing gold's upside. As Peter Schiff points out here, higher inflation shouldn't trigger selling but accumulation, yet markets behave irrationally. The Fed is effectively powerless, and inflation expectations are disconnecting from trader reactions. This misalignment signals a potential sharp rebound as real capital flees dollars for hard assets, investors ignoring this dynamic risk, missing the next surge. Next, Peter Schiff shows why these distortions create a rapid acceleration in gold and silver demand when reality sets in.
So that's what traders are going to figure out, that this is not, bearish for gold because, the Fed's going to have to hold off on rate cuts, as if holding off on rate cuts is even going to matter. If inflation goes up to 6%, 7%, 8%, and the Fed just sits back with a 3.5% Fed funds rate, how is that going to stop inflation? It's not. Now, by the time the Fed acknowledges that inflation has gone way up, it's way too late. Because initially, they get one bad month, another bad month, another bad month, and the Fed, well, let's wait and see. We're not really sure, right? It could be transitory effects of tariffs. It's temporary war stuff. It's oil prices. And so they wait and they wait and they wait. And then by the time they have to acknowledge that it wasn't temporary, now all of a sudden you got the 9% inflation like we got last time. Now what are they going to do? I mean, raise base interest rates 25 basis points, 50 basis points? What's that going to do? Even 200 basis points won't be enough. But they won't be able to do it because by the time inflation is that high, we'll be in recession. We'll have higher unemployment.
The Fed's inaction is more dangerous than markets admit. As Peter Schiff points out here, waiting months while inflation compounds renders modest rate hikes ineffective, and the risk of recession rises sharply. Traders assume short-term fixes will stabilize gold, but history shows delayed Fed responses coincide with market pain. Portfolio risk isn't in paper losses, but in policy paralysis leading to unemployment spikes. Next, Peter Schiff unravels why these delays amplify both inflation and market volatility, forcing investors to rethink exposure strategies.
And if the Fed hasn't already cut rates and started QE, we'll be in a bear market in stocks and we'll have a collapse in the housing market. This was barely a bump in the dollar. So it really shows how things have changed. And the de-dollarization trend is going to continue. And a big part of de-dollarization is buying gold. Because when you get out of dollars, you have to get into something. And what you get into is gold. And believe me, a lot of these foreign central banks are going to take advantage of this pullback in the price of gold. Below 4,500, they'll be big buyers. And in fact, some of the central banks who never even got in on the action, they're going to take advantage of the opportunity. I mean, maybe they thought they had missed it or they were going to have to pay a lot more. So I think this thing is going to turn quickly when it does. And that's why we take advantage of it. Yeah, I know maybe you took advantage of it last week and now it's even cheaper. So that's a good thing if you could buy some more.
Dollar weakness masks an ongoing central bank gold accumulation trend. As Peter Schiff points out here, even minor dips below $4,500 are triggers for foreign buyers who understand real value, not paper signals. Investors ignoring this risk, missing the subtle shift away from dollars, and housing or equity markets remain fragile if liquidity tightens. Understanding the global move toward gold clarifies why a pullback is not panic but opportunity. Next, Peter Schiff discusses how these central bank moves could accelerate gold's rebound faster than mainstream narratives suggest.
And if you're already all in, if you don't have any ability, if you have all the gold and silver that you think you need, okay, it's no big deal. Just because it got even cheaper doesn't cost you any money. You're not selling. Yes, if you end up selling, I know there are going to be some people that get scared because gold is down to 4,500. And they're going to say, I'm going to sell my gold. You don't want to get shaken out of the market. I mean, that's what happens in bull markets all the time. They always want to shake you out. That's what corrections do. They're scary. They get you to throw away a winning hand. Even worse so in the mining stocks. You know, I get people that call up almost always after a big drop. We get clients at Europe Pacific Asset Management. They call up, hey, I want to go to cash. I want to sell my stocks. They never want to go to cash when it's at the highs, but once you get a big drop, they want to go to cash. No, that's not when you go to cash. That's when you buy more. But even if you go to cash, let's say somebody went to cash earlier in the week after, gold stocks were down, 20%.
Corrections often expose the human element in investing. Fear overrules strategy. As Peter Schiff points out here, Selling into a dip is a classic mistake that punishes those who react emotionally, especially in mining stocks. Investors frequently shift to cash after a 20% drop, ignoring that bull markets are about accumulation, not panic. Historical patterns show the real opportunity comes during downturns, not peaks. Next, Peter Schiff discusses why staying the course through these corrections is critical for long-term wealth preservation.
And they went to cash, and now they're down 30%, and they're feeling good about themselves because, hey, I saved myself 10%. It's a good thing I went to cash, because had I stayed in these stocks, right, I would have lost even more money. Well, if you never sold the stocks, you wouldn't have lost any money. I mean, just marking in the market. But what happens if all of a sudden the market comes roaring back and you're still in cash? And then the stocks are higher than where you sold them. And then they go much higher and you're stuck with cash. The reason I own gold and silver, the reason I own these mining stocks is because I don't want cash. I recognize that cash is trash. I know what's ultimately going to happen as a result of all the money printing and all the inflation. We're going to sacrifice the value of the dollar. I don't want to be a sacrificial lamb. I want out of the dollar. And that doesn't mean I'm going to want to get back into the dollar. If my gold and silver go down, I'm not going to sell them to go back to the dollar. That's the last thing I'd want to do. The reason I sold my dollars in the first place was to get into gold and silver. And if gold and silver go down, I'm not going to sell them for even fewer dollars. The whole point of the trade was to get out of the dollar. But this is par for the course. This is how bull markets operate. And sometimes, you know, it can be more brutal than others. I mean, this is a very sharp correction. Obviously, a lot of money was pulled out in a very short period of time. Maybe a lot of leverage was there. People got stopped out of the market. I don't know. But you know what? It doesn't matter to me why people got fooled or why they were forced to sell. I'm not selling any of my gold. I'm not selling my silver. I'm not selling my mining stocks. So it's the people who are selling theirs that are going to experience the loss. I'm going to hold on. And when prices are much, much higher in the future, right, then I'll be rewarded for the fact that I held. And others, you know, who ended up cashing out, whether by force or by choice, are going to regret the decisions that they made.
Cashing out during a sharp correction often feels like safety, but it's an illusion. As Peter Schiff points out here, selling gold or mining stocks to re-enter cash exposes investors to missing the recovery entirely, while long-term positions retain their value. The structural erosion of dollar purchasing power means being in cash is actually a risk, not a hedge. Leverage, forced liquidations, and panicked selling create temporary volatility, but reward those who maintain conviction. Next, Peter Schiff shows how steadfast positioning in precious metals can outperform reactive trading during market turbulence.
So my advice, again, at a minimum, hold tight. If you're comfortable with the position that you have, there's nothing that you need to do. The trend is our friend, and the fundamentals got stronger this week, not weaker. All the reasons that we bought gold and silver just got validated because rising inflation is the reason. And the fact that the government is powerless to do anything about it is the reason. And that's what's happening. And the fact that the Fed has done nothing, the Fed should have hiked rates even before the war. The fact that they're looking at all this data and not hiking rates proves that any talk about hiking rates in the future is BS. They're not hiking because they know all the damage they would do if they hiked. And the longer they wait to hike, the more damage they will do if they do it. That's why I still think the next move is a cut, but not just a cut, a massive quantitative easing program. In fact, they may even crank up the presses even before they cut, so they can postpone having to do that.
The Fed's inertia signals deeper structural risk than markets acknowledge. As Peter Schiff points out here, delays in rate hikes amid rising inflation validate the original thesis for gold and silver accumulation, but also warn that liquidity injections could distort markets further. Investors face the dual risk of inflation and policy-driven asset inflation in precious metals. Understanding that central bank action or inaction shapes long-term returns is key. Next, Peter Schiff discusses why potential quantitative easing could dramatically reshape the next phase of market trends and precious metal valuation.
Now, as far as when the carnage is going to be over in gold or silver, I don't know. I mean, my gut is that it's not going to go much lower than it is. Of course, I didn't expect it to fall as much as it already has. But to keep it all in perspective, we're still at about 4,500 for gold. So relative to where gold was a couple of years ago, that is a big move. And yes, the fact that it pulled back almost 20%, most of it, very quickly, though it's a surprise how quickly and how much it pulled back, looking at a chart, it really doesn't change much. And the fundamentals, as I said, have gotten better. Now, in my mind, I've always known this. I knew that inflation was coming back. So I knew that real rates were going to collapse. I know the Fed is in a box where it can't fight inflation. Powell, when he talked about stagflation, because somebody asked him about stagflation, and he dismissed it as if, it's not even a risk. Not only is it a bigger risk than it was in the 1970s, but we don't have the ability to do anything about it because Volcker raised interest rates to 20%.
The rapid 20% pullback in gold masks the underlying strength in fundamentals. As Peter Schiff points out here, real rates are collapsing and stagflation risk is higher than many admit, yet traders fixate on short-term price movements. Gold at $4,500 is historically low relative to inflation-adjusted trends, revealing a disconnect between perception and economic reality. Investors who understand structural limits on Fed policy can use this as a strategic entry point. Next, Peter Schiff talks about why ignoring these macro signals could leave portfolios exposed to stagflation-driven shocks.
That's a tool that Powell or whoever happens to follow him does not have. How could we raise interest rates to 12% today with a $39 trillion national debt? It wasn't even $1 trillion back then. And of course, it was financed long-term, not short-term. We are powerless. We couldn't even survive 10% interest rates, let alone 20%. But if 20% interest rates were needed back in 1980 to rein in inflation, how high would they have to be now? Because I think we have a bigger inflation problem than we had back then. And we're certainly a much worse credit risk. Our debt to GDP was only about 35% in 1980. It's 125% now. We are far more in debt as a nation. And again, in 1980, we had huge trade surpluses. Now we have massive trade deficits. In 1980, we were the world's biggest creditor nation. Today, we're the world's biggest debtor nation. In fact, we owe more money than all the debtor nations of the world combined. And we're at war. we weren't fighting a war in 1980. We're fighting one now. So we are broke. We are fighting a war that we can't afford. And where's that money going to come from? And who knows if we could win the war? Because I don't even know what winning is. Whatever happens, I'm sure Trump is going to claim that he won. But the reality is, we can't even afford the peace, let alone to keep fighting the war. So we are in worse shape now by a long shot. So when Powell says it's nothing like 1970s, he's right only in the sense that it's way worse than the 1970s. The 1970s will look like the good old days, the roaring 1970s, compared to what we're headed for.
Comparing today's macro to the 1980s reveals structural vulnerability few admit. As Peter Schiff points out here, extreme debt to GDP ratios, trade deficits, and military obligations limit any feasible interest rate response to inflation. Unlike 1980, the US cannot rely on rate hikes to control runaway prices, and conventional playbooks fail. Investors must grasp that monetary power is constrained and systemic risk is heightened.